All right, friends, today we are bringing it back to the macro side of the house, checking in on CPI to see if it even really matters in the context of everything else going on with bank failures and so on and so forth. Does CPI matter as much to what the Fed does at the upcoming FOMC meeting? Now, this was the state of the conversation, this article behind me last week after Powell's testimony. We had gone from a moment where most of the market assumed that we were heading for another 25 basis point hike to higher inflation and Powell's testimony before Congress and the Senate suggesting that maybe actually we were going to get a jumbo 50 basis point hike instead. It seemed like a moment that the Fed might want to really emphasize their commitment and the fact that just because they had reduced the rate of hiking to 25 basis points previously, that didn't mean they were locked into that going forward. However, obviously, since that testimony, the world has changed pretty dramatically. Yesterday, or this morning, I guess, we got an article from the Wall Street Journal's Fed whisperer Nick Timiraos called Collapse of Silicon Valley Bank. Signature Bank calls Fed interest rate path into question. And effectively, it just discusses the rock and the hard place that the Fed finds itself between. On the one hand, real financial stability concerns, and on the other, the need to continue to fight inflation. Of course, on top of that, there is the question of credibility. The Fed is dealing not just with the inflation fight, but the fight to be taken seriously as a monetary actor, right? A huge amount of the Fed's power comes from its ability to nudge markets in the direction that it would have them go without actually having to turn to policy to do it. The less credibility they have, the less powerful that tool is, and the more they have to resort to actual monetary policy. So this is the context into which today's CPI numbers were coming. And for the last 15 months or so, the most important number each month was the previous month's inflation rate, right? It was the determinant of whether we were on track. It was the report card for the Fed in many ways. Now, the second most important numbers had to do with jobs, and given how much the Fed has pinned the continued tightness in the labor market as the reason that it feels like it can keep hiking and needs to keep hiking. That's been a secondary important number, but CPI has really been the front and center. So obviously before everything happened with Silicon Valley Bank and Signature Bank and the Fed's new lending facility and all that stuff, the CPI this week was slated to be the most important number, the most important new economic data we got this month. Interestingly, I think the question is, does it even really matter? I think to some extent that was going to be always about what it said. So what we actually got was a CPI that was pretty right in line with expectations. Headline was roughly what economists expected, 6% year over year, which is down from 6.4% last year. Month over month headline was 0.4%, and that was what was expected. Now, the one number that Jack didn't get in here, which is a pretty important one, is that month over month core inflation, which matters more to the Fed than anything else, was expected to come in around 0.4%. It was actually at 0.5% growth month over month, which was actually the highest month over month core inflation increase we've seen in about 5 months. And it shows the stickiness of that sort of core number that the Fed is looking at. Now, counterpoint, a lot of that was from the very lagging indicator of housing prices, in particular rental prices. And so the market didn't seem to react too strongly. I think in a lot of ways, Genevieve here captures the sentiment. CPI rises in line with expectations at 6% year over year. Jerome Powell just averted a heart attack. Now, still, the conversation is changing around the FOMC and the range of its potential options. As you can see here, this is an article from Bloomberg. CPI suggests that the Fed doesn't have the luxury to delay hike. And the point here is that even if things are going in the right direction, 6% inflation is still extremely high. We still have some evidence that month over month core, especially services inflation, is going up. And that's what the Fed is most worried about. And so you get a situation pretty well summed up in this image of the challenge that faces Jerome Powell's Fed going into the next FOMC meeting. Do they bail out banks, which represents to many a pivot, or do they continue raising rates and get the potential for more financial instability in the form of bank runs, etc.? Now, a lot of folks, I would say that a big portion of the sort of TradFi space, certainly the financial Twitter space or FinTwit space, seems to be on the level that The Fed's lending facility that they just created was created in part to actually allow them to continue to raise rates. In other words, part of the reason to have a standing facility rather than just try to address Signature and SVB and whatever the sort of immediate issue is to understand or recognize that they have now figured out a part of what they've broken with these rate increases, but they need to be able to continue to do them. So that's sort of something that I'm seeing a lot. Logan here says, for those of us in the Fed who won't pivot camp, we do have a new variable to think about. And I do think a lot of folks who were sure that the Fed wasn't going to pivot are at least taking this under consideration. However, whether this is the perspective on FinTwit or not, markets are certainly a little bit more bought in on the idea that there is going to be a pivot. So Croceus says, this is what it looks like when something in the financial system breaks and the Fed has no choice to pivot from QT, quantitative tightening, back to QE, infinity. And so what you have here in this chart, which is a little hard to see, the blue line represents the interest rate, and the orange bars or the orange columns represent the expected number of hikes. And you can see this goes from March 8th to March 9th to March 10th to March 11th and so on, all the way down to March 13th. And effectively what this is saying is that the market switched from expecting a terminal rate up above 5%, only sort of cresting off into next year with, 5 more hikes or something like that, to now being in a position where it expects a terminal rate to be around where we are now, and there to be a number of, between 2 and 3 deceleration, between 2 and 3 rate cuts over the next year and a half or so. So this is what that chart is trying to say. Another version that sort of reflects, I think, this chart is market optimism. You can see that, as Jesse Cohen says here, looks like the stock market is all set for the Fed pivot next week. There is a bonanza out there in markets thinking that the Fed has finally going to have its hand forced. And this is something that we've seen over and over again for the last 15 months, is the market seeing some condition that they believe is going to force the Fed off of its rate hiking path, getting really optimistic, getting out ahead of it in terms of their sort of stock buying activity. And the question is whether it's any different this time than it has been every other time, where every other time what's happened is the Fed has come out and said, don't get ahead of yourself, and some economic data has come out to support their point. The difference here is that there is truly something that has broken now. Now, the Fed may think they have it under control with this lending facility, but that's not gone away. That issue of small banks, regional banks, and the unrealized losses that sit on bank balance sheets has not gone away. I think that if I was pressed to guess where we are headed and what we'll see, I think the Fed is going to want to particularly make a point and kind of test markets at this upcoming FOMC meeting to say that we can do both of these things at the same time. We can deal with financial stability, but we can also keep fighting inflation. I think that sending or doing a 0% rate hike, keeping things similar, would be seen by too many, and the Fed will think it would be seen by too many as a pivot. I think they almost are priced in to doing a 25 basis point hike. And last I saw, the bond market was betting on that with something like a 76% bet on a 25 basis point hike as well. This also follows from comments we've seen from folks like Fed Governor Christopher Waller, who said last October, I believe we have tools in place to address any financial stability concerns and should not be looking to monetary policy for this purpose. The focus of monetary policy needs to be fighting inflation. So in some ways, I don't think that the CPI numbers mattered per se. I think that everything around this particular rate hike is going to be in the context of the optics coming off of these bank failures. But at the same time, I think that the simple fact of the matter of 6% inflation, 0.5% core inflation month over month, it's too high for the Fed to be seen to even be thinking about backing off. So that's the bet that they're going to make. They're going to make the bet that the lending facility that they set up is enough to hold back the dam for further bank contagion for now. That's my bet. We will find out soon enough. Thanks, guys.